Hello, everyone. Welcome back to Valley Home Vibes. In this three-part series called Financing the Home of Your Dreams, we've already covered credit, we've covered income, and in this final episode of this three-part series, we're going to be covering assets, such as your down payment. So, welcome, relax, and enjoy the episode. We're going to move on to assets, and this one can get deceivingly complex. It seems simple enough, right? You just bring your savings to the table and say, okay, this is how much down payment I've got. How much can I afford? So the main metric here is called the LTV, loan to value. The loan to value is really the lender's perspective of basically how you would see a down payment, right? It's the inverse of the down payment. If you've got a loan, let's say of 400,000 and on a purchase price of 500, you're going to have an 80% loan to value, right? So you've got basically 400,000 divided by 500,000. It's 80. Now, if you got it from your perspective, you're really putting down 20%. And that would be how you would state things. That the lender is going to be looking at things in terms of risk, and that's loan to value. 20% is the traditional down payment, and you won't have any MI on you're putting 20% down. However, most people do not put 20% down on their homes these days. And they're usually needing to put down a lot less because as we just demonstrated, 20% down on a $500,000 home is 100,000. MI is where is really the party that comes in to help the banks reduce their risk. If you're putting 5% down on a home, which is actually the minimum down for just the standard conventional 30-year fixed mortgage, the mortgage insurance company is going to be the primary party that they're basically going to guarantee the bank that they'll pick up that risk from, let's say, that 80% loan to value up to the 95% loan to value. Or from the borrower's perspective, they're going to pick up that risk and allow you to put 5% down. Now, private mortgage insurance is what typically you're going to be getting on a conventional loan. FHA is a little different. They have what's called mortgage insurance premium, or MIP. And the minimum down for an FHA loan is 3.5%. And they've got a lot larger premiums on their loans that's paid into a big fund. And this is obviously controlled by the government. But it's beneficial because it's a great stepping stone loan. Typically what the FHA is used for is to help first-time home buyers get into a home, since it does have that low down payment. It also has more flexible debt to income ratio. They have a higher debt to income ratio, but they're usually very strict on income. So typically they do want to see year work profile. Let's get into some of the programs that are available that are, say, low down payment or even down payment assistance. Conventional does have programs available that are not at that, say, 5% down. They have programs available at 3% down. They are coming out with some new ones because since homes are getting so expensive and not a lot of people can even afford 3% down, they're coming out with some programs that are even lower. But programs that exist right now, typically at the 3% down, and they're called Home Ready and Home Possible. These are income restricted programs. So if you make a certain amount of money or below a certain amount, you can qualify for a 3% program. Now, what determines the income is what's called area median income. And typically they're going to go off of what's a percentage. That's how they kind of control what areas, counties, zip codes, what is the area median income. But typically it's 80% of the area median income. So say for instance, they hit the they determine the area median income here in Maricopa County is, let's say, 80,000. The income that they're going to determine you make qualify for these income restricted programs is going to be 80% of that. So whatever 80% of that is what they're going to cap you off at. Now, unfortunately, these programs aren't popular right now because if you are at 80% of say 80,000 or 80% even of 100,000, you don't qualify for a whole lot. So there's other programs that they're not income restricted, but they require a first time home buyer. And they're just called first time home buyer programs from Fannie and Freddie. Freddie has branded theirs as Home One. Fannie is just called a 3% down program or first time home buyer program, but they don't have any restrictions on income as long as at least one borrower is a first time home buyer. Okay. We discussed a little about the down payment here, but where can these funds come from? Typically, your funds that you're bringing to the table have to be from, say, a savings or a checking account. You can borrow from your 401k, any liquid investment, and you can even source it as a gift. So people can contribute to your down payment and closing costs. These funds that you're sourcing, let's say from a checking or savings, they have to be seed. And that means they have to have been in your bank for at least 60 days or 2 months. If you're getting gift money, those are typically coming from like an immediate relative or maybe somebody that is close to you. Conventional has stricter guidelines on this. FHA, you can get gift money from any number of sources, friends, even an employer. And so there's a lot of ways to help with these down payments. And gift funds is actually a very popular way for people to come up with their down payment. So what are some tips for covering this down payment? Today, because of just where we sit here in Phoenix particularly, is the seller credit. Home prices are just so high that a lot of borrowers just need help covering closing costs and that down payment. And typically seller credits are what are offered in the transaction to help them. Now, it's a conflicting scenario when you've got a seller's market and you've got a buyer who really needs seller credits, right? But what I'm seeing in the market right now is a lot of sellers are willing to go up on the home price and use the difference between what they're originally asking and then what they're going up by that new, say, purchase price, throwing that back into the transactions of seller credit. So the seller's really not losing anything if they are going, say, from $500,000 and they increase the price to say $505,000. That $5,000 difference, they're just throwing back to the buyer as a credit so that they can offset their closing costs. That's one strategy that's common these days. Another way of helping with your down payment is what's called DPA or down payment assistance. And these are a double-edged sword because there's a lot more of them these days. And it's probably my most common inquiry is, do you have down payment assistance or do you have any zero down programs? Beyond BA, which is a zero down program, but in order to qualify, you had to have served in the military, or USDA, and which the property is to be qualified as a rural property, which at least here where we are, it is rural until you get well outside of the metro. And typically, if you're buying, say, in the suburbs, you're really needing help from a traditional DPA program, such as what we call an FHA, 100% FHA program. That includes the 96.5% loan to value first mortgage, right? That 30-year fix. And then what they call a community second or a second mortgage that picks up that 3.5%. Now, these are, when I talk about being a double-edged sword, the problem with these I'm seeing is that the interest rates on that second mortgage are so incredibly high, and that also the risk just associated with the whole deal in general, the interest rates can be higher on that first mortgage as well. And they still carry mortgage insurance premium and everything else. What we're seeing is the payments usually kill the deal based on debt to income. However, it's a case by case scenario. And I always tell people that we should look at these FHA 100% financing programs because you never know. Now, there are other programs, DPA programs that are in the conventional space. And in fact, Freddie Mac has just launched a program called DPA One, and they help borrowers source local down payment assistance money. And I predict this will become more popular going forward. since there are going to be a lot more borrowers that really just are unable to come up with the down payment required for a normal conventional loan or even that 3.5%, say an FHA loan. Kevin, Laurent, what is your take on the borrower profile from your point of view and you guys both being involved with real estate?
Actually, I have a couple questions. Two questions, really, is how can consumers use Credit Karma to their benefit if the score is so off, similar to a Zillow's Zestimate? And then second, what would a couple do if one of the spouses is a stay-at-home individual, but gets paid cash with no official record, so to say?
Let me take that first question. Okay, so this is actually almost standard procedure for me. Before I pull credit, I will usually ask my client if they do have a Credit Karma account, and they typically do. And if they don't, they can go out there and get one for free. And that gives me a way to at least see what's on their credit report, like all the trade lines, and see if there's any problems, like say public records, like maybe bankruptcies or even if there's collections. But the score, I always ask them for the score because I have found if you're pretty good at guesstimating these, if you've seen enough of them, you can tell where their tri-merge credit scores will be. And they're typically 40 points lower than what Credit Karma is giving you because it is a Vantage score. So that Vantage score is using a Vantage score 3.0. And the formula, FICO formulas 2, 4, and 5 are typically going to be 40 points lower than that Vantage 3.0. And that's just based off of my experience, right? And that isn't always the case, but I would say that 90% of the time, that's what I'm seeing. It's 40 to 50%, 40 to 50 points lower, right, on their real FICO scores versus what they're getting at Credit Karma. And what was that second question again, Kevin?
The second one is you have two people living together and one of them has a regular hourly or salary job. The second one is stay at home, but they get paid cash. It's just basically under the table with no record. How can that play in? And
Okay. So I'm assuming on the first income earner that they are getting like 40 hours a week and they got like are getting normal W-2. Is that right?
yes, absolutely. A W-2 employee.
Okay. So their income is good to go. On the second income earner, if it's cash, it's trash. Typically. So cash means like nothing. If you're not getting it into the bank, if it's under the mattress, you really can't use it at all. You can never use cash to put, say, your earnest money deposit down on a home. You can't use cash if you're going to be using it as a down payment. Now, if you do have cash and you have time, get that cash into your bank ASAP and let it season for 60 days. Then you can use that cash. Now, if it's an ongoing thing where they're getting cash like on a weekly basis or on a daily basis because it's their job, you can potentially, as long as you're getting it into your bank, right, from the past, it would have to be something that obviously has been seasoned from 60 days ago. But if your ongoing basis, you're receiving cash, you may want to consider getting paid with something that's trackable, like maybe Venmo or even any number of these new payment processing systems, such as Google Pay or Apple Pay or something like that, or even PayPal. Now, typical guidelines don't really allow for that, say Fannie, Freddie, or FHA, but you can get what's called a bank statement loan. And you'll be able to actually use that as income on from the point of view of the bank statement. So if you've been depositing or putting in a lot of cash into your bank account, as long as it's been consistent and stable, you could get a bank statement loan and they'll use bank statements to calculate your income. But it is the underwriting guidelines because this is not a GSE loan or a GOVY, as we call them, government loan, such as FHA. And what I mean by GSE is Fannie or Freddie. It's going to be basically private underwriting guidelines set by whatever the lender is. And so you'll have to ask on what the requirement is to use that as income. Anything else, Kevin?
No, that is pretty clear. I like the phrase cash is trash. I will remember that one.
All right, that's a wrap, folks. If you have questions about home financing or mortgages, please reach out to us using the links below. And please don't forget to click the like button and smash the subscribe button. This is GT signing off from Valley Home Vibes.
Take care, everybody.
Take care, everyone.